Well, I think what you've got to look at is the relationship between speculation and changes in the price. I mean, COMEX is an openly visible market on this one. When you see the price rising and open interest either not following or even contracting, that is a clear sign that the bears are being badly squeezed. And if you look at the level of open interest in gold, it's around about 480,000 contracts, something like that. That's not overbought at all. Yet we've been, as you said earlier, we've been hitting new highs day after day after day. So where's the overbought? It's not overbought. Okay, you look at the RSI indicator. Chartists will say, "Oh, that's overbought," and all the rest of it. But they're looking at the wrong thing. Man does not survive by charting alone. You've actually got to look at the market. So this is a very, very difficult situation for market makers in particular. In futures markets and also in the forward markets in London. I mean, I think in the broader context, what we are seeing is, if you like, the relationship between paper and physical becoming very, very strained. And I think it's a symptom of the end of the fiat currency system. We are beginning to see that the fiat currency system is in huge, great difficulty. Of that, there is no doubt. And fiat currencies don't last forever. They've always got a limited span, and they always collapse, and they always collapse in the same way. They collapse basically because there's just too much debt. The debt just mounts up and mounts up. I mean, the whole point of a fiat currency is you can issue the thing, without constraint. So obviously it gets issued without constraint. So that means there does come a point where the fiat currency can be no more. We've seen, every collapse of a fiat currency is really from that sort of, from the overloaded debt, the accumulation of debt, if you like, the dependence of governments on issuing yet more and more currency. Basically, the shortage of silver has built up over a long period of time. I mean, if you look at the Silver Institute's estimates of supply and demand, you can see that it's been supply deficit for the last 5 or 6 years. And it's in supply deficit this year. And the difference is always made up on the Silver Institute's calculations by drawing down on investment stocks, what they call investment stock. We've come to an end of that. And, the thing that makes it so difficult, I think, is you've got this very limited liquidity. The vast majority of silver in the LBMA vaults is actually for silver ETFs. You look at the big silver ETFs. I mean, basically that accounts for most of it. So the liquidity is actually very, very low, what's actually available. So what we see is authorized participants, as they're known as, the big banks, if you like, who will be listed on SLVs, for example, prospectus. What they can do is they can sell SLV stock for physical. So what they're doing is they're going out and they're borrowing silver, SLV stock from pension funds, insurance companies, wherever they can get hold of it, and paying a huge, great premium to do it. And actually, it's that there isn't any supply of SLV stock anymore, but they then sell it into the market for bullion and then deliver it, and they're left with a short position. They've got to cover that at some stage in the future. So, this doesn't actually resolve the problem. It just deals with one bank's particular position, short term. It's rather like, payday loans. You run out of money and you've got the bills to pay, and you're not going to get paid until next Thursday or whatever. So what do? You go out to payday lender and you pay 120% or whatever the figure is to finance your position for 3 days. That's all they're doing. This is just, storing up continual trouble in the market. I just don't see how this one can really be resolved, because the problem is that all this is going into secure hands. I mean, people are hoarding the stuff effectively. And now, because this is so public, people are subscribing for, guess what? ETFs, silver ETFs, which is reducing. I mean, the silver, the managers of silver ETFs they've got a problem, because they've got to now try and find some silver. And there's very little available in the market. So all these talks about flying silver from New York back to London I should think most of that silver is spoken for by the ETFs. I mean, when's it going to end, Alex? I just cannot see. This squeeze, I think, has got a long way to go, I must say. I mean, the other thing is that you're looking at a gold to silver ratio of around about, it's just under 80. That is very, very high. Particularly if you take the view that we are coming to the end of a fiat currency system. Because the other side of the end of a fiat currency system is the repatriation of gold into its rightful position, which in everyone's common law is final settlement without counterparty risk. It is the true money. And silver has a subsidiary role in that. So we're likely to see the gold-silver ratio fall very substantially. What does that mean? It means the silver price goes up to 100 quite easily. I mean, don't hold me to a particular figure, but, for example. And I think the market is getting the sense of this. And certainly for private investors who feel that they might have missed the gold boat, having maybe taken profits at $2,000 or $2,070 when you remember that was the top trading range for some time, regretting it and thinking we're going to get back in. But how do you buy gold at $4,130 when you've sold it $100 or $1,000 or $2,000 below the current level? This is a psychological nightmare for investors. So what do? Buy silver. It's far cheaper. That way you get it back in the ride, with a little bit of self-respect preserved. So this silver thing is actually very, very serious and continuing.
We have to look at the relationship between speculation and changes in the price of metals, because what we're witnessing is not normal. In the COMEX, the open interest in gold remains at around 480,000 contracts, which in historical terms is not overbought. Yet we are hitting new highs day after day. So ask yourself, where is the overbought? Compared to past cycles, there is no excess leveraged long position pushing prices up. Instead, we are seeing something far more subtle and far more dangerous. The bears being squeezed, open interest not keeping pace with price rises, while the underlying structure of delivery and physical inventory begins to come apart. A lot of the chartists will point to RSI indicators and say, look, this is overbought. But market behavior isn't governed by a simple oscillator. Rather, it's about the deeper plumbing, the link between paper metal and physical metal, between promises and delivery. In the bullion markets of London and New York, that plumbing is now strained. And what that indicates, quite frankly, is the end of the fiat currency system as we've known it. Fiat currencies don't last forever. They collapse when debts mount, when issuance becomes unconstrained, when the faith in the system falls away. A major component of that collapse is the breakdown of the promise-based system: derivatives, futures, swaps, paper metal. That's where silver and gold enter as structural alternatives. Look at the supply/demand picture for silver. Year after year, the Silver Institute has estimated persistent supply deficits. The mining production hasn't kept pace with demand, at least not demand of all kinds, industrial plus investment plus monetary. For years, the gap has been filled by drawing down investment stocks. But those stocks cannot go down forever. They cannot support indefinite deficits. Eventually, someone holds the can. What we're now seeing is that the holding period is lengthening, liquidity is vanishing, and large quantities of metal are being consumed by investors or sovereigns who refuse to resell. That simple fact, more hoarding, less stock turnover, is unbelievably bullish for future price discovery. And what is available? In London, the vast majority of silver in the vaults is already tagged to the ETFS, the paper structures, meaning the free metal, the metal available to the market, is extremely limited. The authorized participants who run the big silver ETFs face a tricky game. They can borrow ETF shares, convert them to physical, sell that physical, and leave themselves with a short obligation. This is not sustainable. It's akin to payday lending in bullion form. You borrow to solve a short-term problem, you pay an enormous premium, you hope the situation is resolved later. But in aggregate, across many players, the system is just storing up trouble. Because if one major participant cannot roll, cannot convert, cannot deliver, the system fails. Not gradually, sudden. These constraints are visible now. It's not hidden. Futures markets show open interest approximately 480,000 for gold, yet price climbs. Futures for silver, lease rates ballooning, backwardation appearing. The divergence between paper and physical is growing. That's the signature of a system under strain, when the paper claims lose contact with the physical reality, because promises only matter as long as the underlying deliverable exists. If the system cannot deliver, those promises become worthless. So what does this mean for the investor or for the person watching at home? It means you cannot view silver and gold simply as commodities to trade. They are money, not in metaphor, but in function. Gold is settlement, final payment, no counterparty. Silver is money and industrial utility combined, which gives it a unique position. When the system of fiat credit begins to erode, when trust in delivery and promise fades, the metal that is money will reassert itself. And the startling thing is, we may be closer to that reassertion than most realize. Recall that the gold to silver ratio is sitting just under approximately 80. That means 1 ounce of gold is worth 80 ounces of silver. Historically, in monetary cycles and in epochs of change, the ratio contracts considerably. Why? Because silver plays catch-up when money is reset, when monetary metals are revalued. If you believe we are entering a reset, or at least a reset in trust, then silver is vastly underpriced relative to gold. The implication, silver could go to $100 or much higher without gold needing to move drastically by historical standards. Yes, pick your number with caution. Nothing is certain, but the logic stands.
What we're seeing in the markets at the moment is a squeeze on lack of liquidity. It's very obvious in silver. It's less obvious in gold because you're not getting the high lease rates and backwardations between London and New York. But nonetheless, there is a squeeze in gold because following earlier this year, when masses of gold were taken out of the Bank of England vaults, basically to arbitrage into New York, a lot of that was leased gold because the principal storers of gold in the Bank of England are other central banks. And the Bank of England has always encouraged other central banks to lease their gold as part of providing liquidity in the London gold market. Now, when you see it actually disappearing out from under the Bank of England's control, you wonder if you're going to get it back. I really do think that central banks as a whole are withdrawing from the gold leasing market. Now, this is very important because it's been leased gold, which has been hypothecated, rehypothecated, rehypothecated to keep the whole system, sort of swimming along. And without that leased gold, we're going to end up with a bit of a crisis. And the other thing which I was sort of thinking this morning, Alex, is that we've had problems in the past in the bullion markets, but they've never been publicly aired, if you like. Only sort of well after the event, you hear that so-and-so had to be rescued or whatever. I can't remember that there was a bullion bank way back in Eddie George's days. And I'm going back to, I think, sort of very early 2000s, when he had to sort of disappear off from a meeting or from smoking a cigarette outside the Bank of England, because he was a wonderful trader and a really, really good guy. He had to go and help rescue this problem. This just doesn't happen now. I mean, we just don't see it. But suddenly, yes, we do see it. And it's all over the press. Everybody knows about, that there's a shortage in physical and the silver market. I mean, they come up with different conclusions as to how to resolve it and what is likely to happen and all the rest of it. But this is a new thing that's become very public, and it must make it very difficult for the authorities to manage a crisis, if you like. I can't see really how this crisis can be easily managed. I mean, in the past, there wasn't, if you like, the sort of current overall level of indebtedness. You had speculators, if you like, driving prices. But if you look at the open interest on COMEX, the speculators are not there. I mean, this is all short squeeze. And how do you remedy a short squeeze? Well, you supply some physical into the market. But who's going to supply the physical into the market? No, not even the authorities have got it. You could argue that the United States might have some concealed silver reserves, but that's just gone onto the critical minerals list, or at least it's been recommended, so it's unlikely that the US government will come to the rescue of London on this one. China, are they going to come to the rescue?
Let's take this further, because the real implications go far beyond the daily tick of gold or silver prices. What we're really watching is the slow-motion end of the fiat currency experiment, a process that doesn't look dramatic day to day, but that in hindsight always appears inevitable. Fiat currencies, by their very design, contain the seed of their own destruction. They depend on perpetual credit expansion, which in turn demands perpetual confidence. And when confidence wavers, the whole system begins to rot from within. Every major fiat collapse in history, from John Law's paper mania in 18th century France to the Weimar Republic, from Argentina's serial devaluations to the more recent Turkish lira implosion, has followed the same pattern. An uncontrolled accumulation of debt, governments addicted to cheap credit, and a public slowly realizing that the paper in their hands promises more than can ever be delivered. The final act is always the same, a run from promises to substance. And that's precisely what's beginning now in the precious metals markets. What makes this cycle different and far more dangerous is the level of financialization. Today's metals markets are not merely venues for physical trade. They are multi-layered constructs of derivatives, ETFs, and synthetic instruments. The sheer volume of paper claims dwarfs the amount of metal that actually exists. When that happens, price discovery ceases to be about supply and demand. It becomes about leverage and confidence, and both of those are vanishing. We're seeing open interest decline even as prices rise. That's the smoking gun. The overbought narrative collapses because what's actually happening is short covering and forced delivery. The bears, those who sold metal they don't possess, are being crushed, and they know it. They're scrambling to borrow ETF shares, to rent silver from vaults, to buy back positions they can't cover. It's like a chain of payday loans stretched across the financial world, each participant borrowing from another to stay afloat for one more week. The interest rate for this short-term silver borrowing, what we call the lease rate, has exploded. That's the equivalent of a stress fracture in the banking system. And that brings us to the most profound point, the difference between liquidity and solvency. The system can paper over liquidity problems by printing currency, by rolling over contracts, by conjuring dollars, euros, or yen out of thin air. But it cannot conjure silver. It cannot print gold. When you need delivery, you either have it or you don't. That's solvency. And right now, solvency is in doubt. This explains why so much physical metal is vanishing into strong hands. The central banks, the sovereign wealth funds, the industrial users, all are accumulating and refusing to release. The ETFs are draining inventory just to keep up with redemptions. The authorized participants, those big banks tasked with creating or redeeming ETF shares, are caught in a vice. To satisfy delivery, they must source metal that no longer circulates. And to do that, they borrow at ruinous rates, betting that somehow later, prices will stabilize. It's a dangerous illusion. Every ounce that leaves the market for long-term holding tightens the noose. It's not just investors doing this, it's governments. When the United States quietly reclassified silver as a critical mineral, it effectively admitted that silver is indispensable, not only for solar panels and electronics, but for defense applications in the future of energy infrastructure. And what happens when a metal is deemed critical? The government begins to hoard. Officially or unofficially, it doesn't matter. The effect is the same. Supply to the open market shrinks. Now couple that with what's happening in Asia. China and Russia are not merely buying gold and silver, they're rewriting the rules of global settlement. China's Belt and Road trade corridors are being underpinned increasingly by commodity-linked agreements, oil for yuan, copper for credit, silver for solar expansion. They're setting up alternatives to Western settlement systems, complete with their own bullion exchanges and storage facilities. The Shanghai Metals Exchange is building vaults across multiple jurisdictions, offering nations a place to store their reserves outside Western control. That's not a minor detail. That's a declaration of monetary independence. When you understand that, you see why the backwardation in silver, the premium for immediate delivery, is not an anomaly but a symptom of a larger shift. It's not just traders being squeezed, it's the architecture of fiat money itself being questioned. Because if a few 100 million ounces of silver can't be located without pushing prices violently higher, what does that say about the value of all the other paper promises out there? The truth is, the fiat system is backed by debt, and that debt is backed by confidence. Gold and silver, by contrast, are backed by nothing but themselves. That's why every monetary collapse ends the same way. Gold reasserts itself as the ultimate settlement asset, and silver follows as its indispensable sibling. The psychology of this moment is critical. As fiat weakens, you'll see a peculiar blend of denial and panic. The establishment will tell you that everything is fine, that inflation is transitory, that rates can be managed, that central banks are in control. But behind the scenes, those same institutions are buying metal. They are doing what every regime in history has done when their paper empire starts to fray. They prepare for the return to real money. I often remind people that the gold and silver ratio, currently near 80-1, is a measure not of intrinsic value but of distortion. In a true monetary environment, where both metals circulate and are held as stores of value, that ratio would be closer to 15-1 or 20-1. What will drive it back there is not sentiment, but necessity. When gold becomes too expensive for the average investor, silver becomes the gateway. That's when the psychological transfer happens. People who miss the gold train buy silver as a proxy. They tell themselves, I can't afford $4,000 gold, but I can buy $80 silver. And in aggregate, that flood of new demand ignites the secondary explosion. We're entering that phase now. Silver, for decades treated as a byproduct metal, is reclaiming its monetary identity. The industrial narrative, the solar panels, the electric vehicles, the 5G networks, is merely the pretext. The deeper truth is that silver is becoming a store of value again, not just a raw material. And let's not forget the behavioral feedback loop. As prices rise, confidence in fiat erodes faster. The higher silver and gold go, the more obvious it becomes that something is wrong with the system. The mainstream will call it speculation, but it's not, it's repricing. It's the market discounting the future of paper money, and that repricing will not stop at $100 silver or $5,000 gold. Those numbers sound wild only because we are still measuring them in a currency that is itself melting.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.